Welcome to Flywheel Leadership. I'm Graham Peely and I'm joined by Cameron Bishop of Raincatcher. Cameron's our first repeat guest on the show. Welcome back, Cameron.
Hey, thank you, Graham. I'm so happy to be here again.
Yeah, appreciate you taking the time. And my voice is much better this time, thankfully, so not struggling like I was
Yes, it
before.
is.
Um,
Yes,
I,
sir.
I know your mission is to help business owners exit their companies when it is the right time and in whatever the right way looks like for them. As a place to start, I'd like to start hearing about just what your assessment is of what you're seeing in the market and anything of that nature.
Yes, absolutely. Well, the M&A market over the last, I guess we're kind of 6 years into it now, has had some pretty dynamic ups and downs. Obviously, M&A transactions pretty much came to a halt during the COVID period. And then coming out of COVID, there was a feeding frenzy of deals that got done, primarily by private equity firms who they get their funds to invest from limited partners, and they have a limited time frame to invest that money and to let it start to grow for the owners before they have to return that money and flip those companies. And they had a lot of pent up demand and money that they had to get put to work. So that was a great period of time, especially for those of us in the investment banking world. It pushed valuations up pretty substantially. Deal terms were a lot more flexible. And of course, we were in a very low interest rate period at that time. So all of those friendly forces came into play at one time. And then we started to see supply chain challenges come into play that created huge questions and issues for business owners of any kind. And it created complex dynamics around things like inventory levels. Some businesses didn't have enough inventory to continue and or with assurances for buyers. Others, they overspent, and then they wanted buyers to pay for that overspending. And buyers are very hesitant to do that. So that created a set of dynamics. And then we moved into questions around interest rates, which were increasing rapidly at that time. And that, for a while, kind of brought things to a halt because buyers, they determine valuations based on the amount of equity that they put in, and then the rest they fund with debt, normally from banks. There's a lot of private banking happening now, but still, if interest rates are higher, they can't afford to pay as much for the company, or they're going to create deal structures which allow them to offer a higher enterprise value on the deal. But those deal structures quite often aren't very attractive or friendly to the seller of the business. So we've gone through a lot of that in the last few years. The second half of last year, we've seen quite a pickup in deal flow moving into 2026. Again, our firm, Raincatcher, we're what's called a lower middle market investment bank. So we work with business owners with EBITDA profits generally kind of in the 2 million to 10 million range, who are heavily underserved because small brokers really don't have the financial sophistication to help them. And big banks, they're just too small for the big banks. So those deals are beginning to come back to market now. People have kind of settled in with an acceptance on the interest rates where they are today. And a lot of this sort of tsunami we're starting to see is heavily driven by the continuation of the aging out of people who own companies. The vast majority of them are baby boomer generation, and the vast majority of them do not have children that want to enter into their business. And when it's time to retire, they're really left with no other viable option than to sell the company. And that's, again, where we come into play. Our inbound lead activity and referral activity has been up substantially. For our firm, at 11 years in business, we're on an all-time record year. And we really haven't changed what we've been doing. It's just that the market is turning, and a lot of these owners are realizing that it's time to take some action relative to the future of their company and their own personal retirement plans.
6 years since the impacts of COVID started really being felt, which is wild. That time has flown. A lot has changed in the market since then, and it sounds like it is hot as ever in the last 6 years. Would you say?
I would say there's definitely been some peaks and valleys in there, but again, I'd say right now we are on a very positive upward track, again, relative to our kind of business
Right.
where we are representing these owners. Graham, I think it was 3 or 4 days ago, I got this fascinating, extensive, and comprehensive white paper that was put out by McKinsey's, the big, huge consulting firm, their team that studies uh, companies, particularly small and privately owned companies. And it's fascinating and it totally validates and then exponentially more exactly what I've been talking about on these podcasts for these business owners to realize. I think our last call, Graham, I might have mentioned that research I've seen that of all of the companies that come to market, 80% of them won't sell. And that still remains true. In fact, I'm just going to read a headline from the McKinsey. It says by 2035, 6 million small businesses will be on the market as their owners retire. More than 1 million of them are viable candidates for transfer, representing 5 trillion in enterprise value that could remain productive. Now, the key there is their forecast is 6 million businesses will come to market and 1 million of them will actually sell.
Mm-hmm.
And that's key to my theme and my passion for trying to spread this message to help business owners understand how really difficult it is to sell a company and what makes a company even sellable at all.
Mm-hmm. So let's stay on that point as just a for somebody who's listening that may just be exploring this initially. Like, what does create value in a company?
Yeah. Well, the first thing that these owners have to do is truly realize, and it sounds kind of corny, but it's true, that there is a very big difference between working in their company as opposed to working on their company. And because so many owners, they don't delegate effectively is one factor, and they're used to calling all the shots. And in many cases, the company is heavily dependent on their talent or their knowledge or their customer relationships. And that forces them to stay deep in the weeds in the business on a regular basis. And then those cases are focused on top line revenue, uh, doing what they can to mitigate their tax exposure and to take a distribution at the end of the year because most of them are legal pass-through entities, either S corps or LLCs, as opposed to what they need to do to invest in their company by working on it in order to position it for a maximum exit value. And again, in many cases, Graham, to even make it sellable at all.
Mm-hmm. Makes sense. You said something on our last episode together, Cameron. Fall down 7, get up 8. Could you tell me a little bit more about why is that important to you?
Well, that is my personal kind of philosophy, I guess you might call, along with the Japanese concept of ikigai, which is to essentially to have a passion. And being an investment banker for me was a complete career change, but that's part of my later career status and ikigai. I have a passion for this work. Love helping these business owners and trying to help them get their company prepared. But on my fall down 7, get up 8, I did a very, very complex turnaround on a $60 million 501c3 business that was failing rapidly. And the previous management had sort of clamped down on people, and there was a complete dearth of innovation and creativity because those things were not incentivized. And in fact, if they tried something and didn't work, it was usually a punitive outcome. So it took me a long time to change that corporate culture. And to get these folks to understand, again, we're in a turnaround mode. We've got to try new things. And at the beginning, they were very hesitant, and the employee base was extremely talented and intelligent. And in order to utilize and exploit those skills, I had to get them comfortable with the fact that failure is not a sin. We're never going to fail if we don't try new things. Yeah, we want to fail fast, if at all possible, but we're going to fail. We're going to get right back up. We're going to learn from those lessons, and we're going to move on. That was similar to my career path. I don't think anybody has a linear career path that is perfect without some ups and downs and some failures, and I had mine, and is often the case. You generally learn more from your mistakes and your failures than you do from your successes. And in my case, that turned out to be a blessing.
Cameron, in your experience running companies and helping business owners get ready to exit, what's the biggest thing that you see that is typically hardest for them to see? What is that kind of hidden thing that the outsider may see it, that's not living it day in, day out, but what is it that is just not seen easily by that owner or business owner or founder?
Yeah, I'd say a couple of things. First of all, I have never met a business owner, literally, and I've talked to hundreds of them, who didn't think that his or her company was worth more than it actually is. And on any business, the market is going to set the value. And they can cite all the internal things that they think create value, but the market usually doesn't see it that way. The second thing is, and they're probably equal in weighting, is that by and large, they have no earthly clue about how difficult and complex it is to sell a company and what the nuances are that can create a scenario that I call the price isn't always the price. And they'll tell me, well, John Doe's company does what I do, and he sold for some mega amount of money, but they have no detail. They don't know if there was real estate included. They don't know if the buyer got all the cash on the balance sheet, or if there was tremendous amount of unusual inventory and the buyer got that for free as part of the purchase price, which is actually both as our net effective reductions in the actual realized valuation on the company. They don't understand those things. And there's that old expression in the law world that he who represents himself in court has a fool for a lawyer. And it pretty much holds true in the investment banking world, because when they get into a lot of the complex issues around balance sheets and net working capital, they can lose their shorts, and they don't even realize it when that happens.
So makes me think about founder reliance as well. Like how much a company relies on that founder or business owner, that CEO, to just run day to day. And as soon as they step out for, a health issue, vacation, or whatever, they get distracted with other ventures, that business starts to decline or just go backwards or whatever. What kind of impact does that have on the valuation of a company when too much relies on that ultimate leader, that business owner or founder?
Yeah, that is one of the huge barriers that we run into. It's an interesting concept that almost every strength is equally a weakness. And the majority of business owners they're willing to take on calculated risk. They're incredibly hard workers. They control the entire operations. But at the same time, most of them are kind of control type individuals, which helps them to become successful. Let's be clear about that. But at the same time, most don't effectively delegate. And therefore, it's one of the kind of 5 key factors that we first look at to assess the sellability of any company. And that one is called owner dependency. And our sort of litmus tests of that are they the key holder of critical technical knowledge in the company? And does anybody else have that? And quite often, again, their success has relied on their technical acumen and knowledge of the product and the market. Secondly, we do ask them if they have a number two in place and how do they delegate with them. Most of the time they don't, or they don't have an active plan to delegate and begin to transfer that knowledge and allow them to begin making decisions. We also ask them, what's your role with customers? What role do you play in customer relationships? And we recently had an individual, very talented gentleman. He was making a lot of money, but our question was, well, when the phone rings with a potential piece of new business, who answers the phone? And he very proudly kind of sat up in his chair and he said, well, I do. And for us, that's like a double red flag because he's in control of all those customer relationships. And ironically, business buyers are open to taking on risk. That's why they're buying companies. But at the same time, they're extremely risk averse. And that is a red flag for business buyers. And ironically, when these owners want to sell a company, they want to sell because they either want to retire right now or in a very short period of time, 1 year, 2 years, 3 years. And if a buyer is going to buy the business, they're going to expect that owner to stay on, which doesn't really achieve his or her motivations for trying to sell the business. The other interesting one we asked them, very conversational manner. This is our opening discussions with them to, learn where their heads are at and how we could tailor a process to meet their objectives. And we say, well, when was the last time you took a vacation? And again, many of them proudly say, well, I haven't taken a vacation in 2 years or 3 years. Well, that's another red flag because that tells us that the company probably can't really stand on its own without them there. The opposite is I have a current client right now we're in active market with. And he said, yeah, I'm leaving for 3 weeks in Africa on a big game hunting trip, and I'll be off the radar, off the grid for 3 weeks. And we know that's a company that's well structured. They've got trust in their senior management, and they've given them the authority and autonomy to run the company. That's a healthy business. So that's just one of the key factors around the manager's role, the process. And that's why if they can begin to work on the company, a big part of that is they're going to have to invest in a management structure so that they've got somebody positioned to take over when they step out, and that the buyer will be confident in that individual's ability to step up and lead the company.
Enterprise value. So when you talk about the valuation of a company, what is the number one thing, or maybe it's a couple if you can't just nail it down to one? Because I know there's many where the number one focus or top few focus that an owner should have to increase the value of their organization.
Well, ideally, they should have some continuous record of increasing financial performance. And by that, I mean top line revenue and bottom line profitability, usually at the EBITDA profit level, earnings before interest, taxes, depreciation, and amortization level, but also at the gross profit margin level. And most business owners never or rarely ever focus on gross profit, which is their revenue minus their cost of goods or cost of materials, to get a gross profit, and there is a margin attached to that. And when we get calls from buyers about any kind of company, those buyers know what the average gross profit margins are in whatever the industry might be. And if our client or potential client has gross profit margins well below the industry average, oftentimes that's an automatic out for potential buyers. They don't want to have to hassle with it. If they're at the industry average, then it's a non-factor. If they're above that, that can be an attractive and oftentimes a value enhancer for these businesses. So, but I get a lot of company owners who, they're kind of tired and they're beginning to see their financial performance either stagnate or worse yet, decline. And that's when they're motivated to sell, which is frankly the worst possible time to
Right.
try to sell. Because again, buyers either are not going to be willing to buy that business, so it becomes unsellable, or they're going to pay a steep discount, and it's often in combination, they're going to propose relatively unattractive deal structures for the seller, again, to mitigate their risk on the deal. That can involve earnouts based on future performance potential. It can involve the seller carrying back what's called a seller note, which is basically loaning the buyer part of the money for generally it's a 5-year period with varying interest rates and payback structures. And sometimes they're going to want them to roll over equity as part of the deal. So those are all factors that come into play, and they can all be part of any one deal.
So what are you seeing with companies when it comes to AI? Like what are you seeing as the real impact so far with those companies as far as, that you're working with?
Yeah. Well, it depends on the industry. One of my partners focuses on SaaS platform software companies. And interestingly, those types of businesses are all subscription model based, and they're pretty niche focused and specialized. And we're doing extremely well there. There's still a huge market for that. I've talked to a guy yesterday afternoon from Singapore who is trying to source SaaS platform software companies. In our firm, I handle the majority of any kind of construction industry related deal. Well, most of those deals, the utilization of AI, if it's being used at all yet, is in the back office for efficiencies, for bidding purposes, for deploying fleets more efficiently or effectively. A lot of the industries that we work with, which are extremely attractive to financial buyers, particularly private equity right now, are businesses where AI is not going to play a direct role. Robotics may someday, but if you have to have a guy come and service your air conditioner or your furnace, AI is not going to fix that. Somebody's going to have to come out there with a set of tools and knowledge about the business and take things apart. Now, they may utilize AI for efficiency to do problem solving research based on the problem they're seeing and the brand of the product, etc. But there's still going to be people out on the streets that have to do that manual work. Do road resurfacing companies. You got to have guys on the back of the truck who are dropping new asphalt or grinding the old asphalt off. So we're going to see those types of professions for many years to come.
Cameron, anything you want to highlight that is a focus for you for the rest of this year?
Yeah, again, my central message is for business owners to actually think about when they want to exit their company. Doesn't matter if it's a year from now or 5 years from now. They need to plan in advance. And the further advanced they plan and the more they position the company for a maximum valuation, the higher the odds that it's going to be sellable. Again, the McKinsey research I just cited, 6 million try, 1 million succeed. They have to work on it. And they also need to understand, a lot of them get stubborn and, well, that's not enough money for me yet. They're all going to leave their company one day. It's inevitable. And they can choose to leave it when they have control and can maximize the value, or they're going to exit involuntarily. And then what we've seen, and I've seen sad, really tragic cases of this, where the owner passes away, they don't have delegation in place, and it's left to the grieving family. Often in this day and age still, most companies are male owned, although we do a fair amount of female owned companies. And the grieving widow or widower, whichever, is left to deal with a business that they have no knowledge of, no understanding of. And that's like stress compounded on stress. And I've seen companies literally implode because of that, because the workers are directionless And one of the case was an HVAC company. So 2 or 3 of the senior HVAC technicians who worked on a lot of commercial equipment, they had all the relationships because they were in there repairing equipment all the time. They looked around. They didn't know where the company was going to go, if it was still going to exist. So they left and started their own company. There was nothing, wasn't an ideal thing, but it wasn't illegal. And it was human nature when you have uncertainty. And that caused the company to die, and it was unsellable. So the family didn't extract any value out of a long-standing, successful company.
Anything else you'd like to touch on today, Cameron?
I think those are kind of the keys. I'm always happy to answer questions. In our world, interestingly, I came from a world where you were selling all the time. If you weren't selling, you weren't going to succeed. And I found it interesting in the world of investment banking is that not only do we not try to sell business owners on selling, we actually would consider it highly unethical. But I have on frequent occasions talked to owners out of selling because based on the goals and objectives that they described for me, I knew selling at this time was not going to be in their best interest. So, and the last thing I would say is, and I see more and more of this, business owners need to understand the difference between a lifestyle business and a ongoing enterprise that is going to be a successful factor with or without that owner. I had a call a few days ago from a very profitable consulting firm specialized in a niche sector of the energy transfer industry. And it was 2 guys that were extremely well respected, extremely knowledgeable, but they literally were the business. And they couldn't understand why someone wouldn't want to buy their company. And the key litmus test there again, Graham, is if that individual got hit by the proverbial bus tomorrow, would there be an ongoing revenue stream? And there is not. Don't get me wrong, a lot of these companies make tons of money. I've talked to some individuals, they're making 7 figures, but the business was solely reliant on their knowledge and expertise. And owners need to be aware of that. And if they want to build a sellable business, they need to begin to invest in it, expand, build out a team so that if they exit, there's ongoing transfer of knowledge that can occur to make it an ongoing enterprise.
How can listeners best follow you?
They can find me on LinkedIn quite easily. I'm really responsive to messages there. Also, my company email is cameron.bishop@raincatcher.com, or they can easily find me on our corporate website, raincatcher.com.
Cameron Bishop, Raincatcher, thank you for appearing again on Flywheel Leadership. We appreciate you sharing and hope to have you back in season 6.
I'll be here, man. I'm ready for you when you're ready.
Appreciate it. Thanks for being on. Take care.
Thank you.